Well, good afternoon, everybody, and welcome to another episode of the Industrial Real Estate Show. I'm very excited to be joined by Adrian Ponsen, who's with Costar, and he's going to give us some awesome data on what's happening in the industrial real estate market, share some of the research and what he's following, and perhaps even talk about an outlook and some of the market changes that we might be wanting to follow. So a lot to unpack, a lot to cover, but first, Adrian, thanks so much for joining me on the show.
Absolutely. Thank you for all the great podcasts that you've put on. I've gotten a lot from you and your guests, so I'm glad to contribute.
Oh, yeah. Very excited to have you on here. And you and I've chatted a number of times as well already. So to have your insights on here, I think will be valuable to everybody. So very glad to have you here. Before we jump into the meat of the episode, can you just talk about Costar and what you do there?
Sure. So as many of you probably know, Costar is a giant database of commercial property information, analytics, and news. We're always expanding internationally, but just to give you a sense, in the US and Canada, we're tracking about 6.5 million commercial properties, about 1 million of which is industrial and flex. And we track everything from physical attributes like the clear height, the number of docks, to things like the tenants, any space that's available, any space that's been available historically, anytime the building has sold, the owner information, et cetera. So it's really it's an essential tool really for understanding, the landscape of available space that might be out there in your market and for looking for investment opportunities, especially off-market investment opportunities, because we're tracking everything, regardless of whether it's for sale. And what I do is, my job is to write news articles about trends in the U.S. industrial market, give presentations on the state of the market for our clients, oversee our industrial real estate market forecasting. And we also have a team of more than 30 analysts across U.S. and Canada that are writing and presenting about their local markets where they're embedded. But they cover all property types. So my job is really to help them, cover industrial as best they can, understand the national context and how their market fits into that.
You guys do an awesome job. Just as a promo for you guys, I love the articles. I read them regularly, so I commend you guys for the great work you're doing there, and look forward to continuing to read them. How did you get into commercial real estate research?
So that's a pretty wild story, actually. So I studied urban studies at University of Pennsylvania in Philly, where I still live, and I was taking classes, things like urban history, urban research, also statistics, and part of that program is we have an internship, and I did my internship at a home ownership counseling nonprofit, and so my first interview with this nonprofit, this was 2006, and I get there, and what they tell me is I'm talking to the executive director, and she's saying our mission of our organization is really to promote financial literacy and prepare lower and middle income people for home ownership, but we've had to completely shift focus because of this foreclosure epidemic that's going on, to where now our main focus is just kind of trying to help keep homeowners in their homes. And so, but we don't really have a good big picture sense of what's going on here. And so, what they said was, we're looking for somebody that can do some research for us on, for example, how big in scale is this foreclosure epidemic that's going on? What neighborhoods are getting hit the worst? Which banks are holding most of these loans? And so I'm sitting there, as a college junior, really no idea of the full scope of what I'm about to kind of step into. But what I was doing was basically pulling down every time the bank issues a foreclosure notice, the sheriff's department here has to post it online. So I was basically pulling those down and databasing them, the address, the bank, and doing all kinds of research on this epidemic, really. And I just kind of continued to do that for the next 2 years. And so that at that point I was kind of hooked, because it was a really interesting topic, and it just kept getting more and more relevant over the next 3 years, really. And so I also took some classes. A great part of this program was we could take like real estate finance classes at Wharton. So I took some of those, and I ended up doing. I worked for a company called PPR, which Costar eventually acquired, and what we did was real estate market forecasting and consulting for institutional investors. So they would come to us and say, we're seeing this kind of opportunity in the market. We need you guys to put some data around it. Help tell the story, help us build our pitch books and some of our fundraising materials. So that was really great for me, because I got to, even when I was in my mid 20s, I was able to listen to what some of these top people of these institutional funds were seeing, and how they're thinking about the market. And along the way, I joined CoStar's team of market analysts, which I've been on for more than 6 or 7 years now. And 3 or 4 years ago is when I stepped into this role, just exclusively covering industrial. And again, popping in at the right time, just as things were starting to get really interesting. So that's a bit about how I ended up here.
You've had interesting timing twice then, going back to 2006 when that was a crazy time. I was new into my career then as well. I started in 2005, and all of a sudden, before I know it, we're entering into the great financial recession. So talk about being thrown into the fire. And then for you to then get into it 5 or 6 years ago into industrial, which has been the biggest boom in the industrial real estate market ever. So that's interesting timing on your end there.
Yeah, absolutely. But I love economics, and the thing I love about real estate market research is that it ties back into the physical world. So I get to look at all of this data, but I'm seeing how these aren't just kind of numbers on a stock ticker. You can really see how they're shaping the world that we live in. So, and I feel really glad to be here at CoStar, because, like I said, I love data, so I get to kind of sit on top of the company that has the most of it for me to look at.
Well, that's a perfect segue into the next question I have for you: is what is the data saying about the current industrial real estate market?
Sure. One thing I should say from the start is we're almost in a situation where we have two separate markets right now. I mean, the small bay market and the bulk distribution market, they've always behaved differently, but the divergence in the two is really the most pronounced that we've seen ever since we started, really tracking data in the early 2000s. And so the reason for that is because almost all the we've been through this historic construction wave, and almost all of that new construction is happening on the bigger box, bulk distribution market. So just to give you a sense, when the amount of industrial space under construction peaked nationally in 2022, more than 90% of the square footage of properties under construction was in properties 100,000 square feet or larger, even though those properties only make up about 55% of the inventory. So just a little bit over half, but over 90% of what was under construction. And the reason for that, well, a big reason is that a lot of developers would tell you that it takes the same amount of time to purchase a piece of land and get it entitled for a $500,000 or a 250,000 square foot distribution center as it does for a smaller one. So from their perspective, it's a more efficient use of their time and capital to focus on the bigger projects, obviously. And so that's one of the reasons that there's been so much supply coming to the bulk distribution end of the market. Small bay is really proving itself to just be perennially undersupplied. And net absorption, even in the small bay market, is actually slightly negative right now because tenants are just digesting these enormous rent increases that they've seen over the past few years. The economy is fairly slow, but that's really even with absorption slightly negative, because there's so little construction. It's still very easy, at least compared to history, to get these smaller spaces leased in most markets. Most have, when you look at properties, under 100,000 square feet, or especially under 50,000 square feet, most markets have vacancy rates that are only 2 to 4.5%, so very tight. And one of the things I'm also looking at is just the time that these smaller spaces are spending on market, which is really interesting. So if you think about them like LA and Inland Empire, these have always been prime, very tight markets, especially small bay markets. And prior to the pandemic, the median time that a 10 to 25,000 square foot space would spend on market was about 3 or 4 months. And that was the lowest in the country. And that's still roughly where they are right now. But what's really interesting is a lot of these, especially markets in the Sun Belt, just these migration hubs, like places like Las Vegas, Nashville, Orlando, Jacksonville, very fast growing cities. Prior to the pandemic, average time on market for a small bay space in that size range I just mentioned was 8, 9, 10 months. But now that's down to even 3.5. And in all those markets I just mentioned, the median time is actually lower than LA right now. So I think a big part of that is so much of the small bay market is driven by housing. So many of these tenants are HVAC contractors, exterminators, et cetera. And so a lot of these markets in the Sun Belt have seen their populations just continue to explode, but there's really not much being built on the smaller side. So you just have this space shortage developing that didn't exist it was still a tight market, but you didn't see space shortages on the level that you do now, even just 5 years ago. So that's kind of what we're seeing on the small bay side. On the big box logistics side, and so just to give you a sense, like the difference in vacancy between properties under 100,000 square feet versus over 100,000 square feet is as wide as we've ever been tracking it. So for the under 100,000, it's about 4%. For the over 100,000, it's, let's see, I got that here. It's 8.8, which is the highest in that segment since 2013. And the amount of construction that we saw added in that bigger category, about 2.2 billion square feet since the beginning of 2020. So that's almost the equivalent of adding the entire inventory of the DFW market twice in the span of 4 or 5 years, right? And the demand for that space really exploded during the pandemic, and that was impressively strong as well. But it grew by about 1.7 billion square feet. So that's still about a 450 million square foot difference of additional vacancy that we have now that we didn't have prior to the pandemic. And that kind of explains that vacancy increase that you've seen. And more recently, net absorption has also slowed down a lot in the big box too. What we're seeing is a lot of it's still positive. It's marginally positive, but not enough to keep vacancy from increasing with the new construction that's coming online. And tenants that are giving back space is a lot of tenants who sell things like furniture and appliances and home building materials, because here in the U.S. mortgage rates are 7%, and that's really keeping home sales very low. They're basically at the lowest level since the GFC. And so what that means is there's fewer people moving into new houses, fewer people buying mattresses, washing machines, sofas, et cetera. And so we see see a lot of the tenants giving back space in that category, and also some 3PLs that they may be leased ahead of their long-term needs when the market was really exploding in 2001 and 2021 and 2022. So in that bigger end of the market, vacancy is rising.
What I couldn't agree more with everything you said there. And it's funny, I was on a call just before this chat here, and I said the exact same thing, is that there's a huge difference between a 10,000 square foot, 5,000 square foot little flex space and a 200,000 square foot distribution space. Yet it all gets lumped into one overall market statistic. Someone might be looking at a market and they'll see, okay, vacancy rate for industrial 7%. That means I should be able to find that 2,000 square foot small bay for my HVAC company very easily. But in all reality, it's probably very challenging finding that 2,000 square foot bay, but you could find 10 options for 200,000 square feet. How is there a way that can be better communicated to the market in your opinion, and whether that's at your level, at Costar's level, or individual firm level? How do you communicate that huge discrepancy between the two different parts? Even though they're both technically industrial real estate, they've got completely different fundamentals.
Yeah, I mean, we're just, anytime anyone asks any of us about the market, that's usually where we start. And it's funny, part of my job too is to just try to get Costar's data cited in as many media sources as possible. Mm-hmm. And what I find, I've had no trouble. There's always this negative bias towards media in general, I think, and so I've had no trouble getting stories about the slowdown in the bulk distribution market kind of broadcasted in different publications. But I've been pitching this story for a long time that, we really have a nationwide shortage of space serving small blue collar businesses, and I think this is something we should talk about more and get out there. But it's just hard to get, from what I've experienced, it's hard to get media sources to latch on to that story. I guess it's a little more complicated, and it's maybe not as alarming. So it doesn't, they don't publish it, but it's something I'm definitely pushing. Yeah,
there's that one media anecdote that I heard a long time ago, and it still remembers me. It still sticks in my mind. It's dog bites man, not a story. Man bites dog. Now that's a story. So, yeah, there does tend to be that fear factor or just the angle that they want to take at any given time. And I stopped consuming a lot of media for that very reason, as I just found it to be so negative. Hopefully you can get some traction with it. I know that there's like I know that Globe Street and BizNow and some of like the actual just business publications quote a lot of Costar stuff. So that's what I tend to read, and hopefully other people do as well. But yeah, I mean, it's such a great message because it is a shortage. There is a legitimate problem there. And that point that you made about in markets that have had a huge population growth, that's even more problematic because that inventory hasn't caught up or nearly at the same pace as the population growth. So there's going to be even more constraints on that. And I suppose it leads to more opportunities too.
Right. I'm glad you brought that up because, so I was just talking about how spaces are flying off the market in, a lot of these Sunbelt hubs for immigration, right? But think about that, and a lot of that's driven by tenants in the construction trades, or tenants that are somehow tied to housing. But that's happening right now, and that's with mortgage rates at 7% and home sales at a 10 or 12-year low, right? So, as I said, like absorption has slowed even in that small bay market a little bit. But when you think about the pace at which spaces are still leasing in a housing market that's the slowest it's been in 10 or 15 years, imagine what that segment of the market is going to be like if we actually do see mortgage rates come down a percentage point or two, and we see even just normal levels of home sales and home construction pick up to a more normal level, then that's just going to cause that market to tighten further, especially given that there's really no construction in that product type in the pipeline.
Yeah, that's such a good point. And I guess that leads to the next question I had for you is your outlook. Like, what, using the data that you have and seeing all these trends develop, what is your prediction or your outlook for the future of the market here?
Yep. Well, we see vacancy peaking at some point towards the end of this year or in the first half of 2025, and then to start declining again. And I'll break it down really by supply and demand one at a time. The supply side, in terms of new construction and that hitting the market, that's the easiest piece of the puzzle to predict, because we're already tracking this huge inventory of projects under construction, and we're tracking them even when they're in the proposed stage and as they pour the slabs, et cetera. So it's not difficult using our data to see how much new supply is going to be delivering 6 months from now, 12 months from now, et cetera. And the good news there is that the amount of new construction that's delivering each quarter, that's already started to turn down. Q1 was the first quarter in a while where we saw a significant reduction in the amount of new space completing. It dropped by about 30%, but the amount of square footage that delivered. And that's just going to keep going because construction starts for industrial started to pull back at the end of 2022, really, when interest rates started moving up. So that was almost 18 months ago now, or more than 18. Yeah. And so the average construction time for a big industrial project in our data is about 14 months. So it makes sense that we've started to see the reduction in deliveries as a result of that pullback in starts that occurred 18 months ago. But starts have continued to trend down, and they've really been at 10-year lows for at least the past 6 months. And so what that tells us is we're going to see less new supply delivering every quarter from here on out. And once we get to the summer of 2025, deliveries are going to be at least 10-year lows. We can already see that based on the volume of starts that's happening today. So it's really those new deliveries that have been the key factor driving vacancy up, especially in the big box end. So the good news is that we can see the end to that in sight already. In terms of the tenant demand side of the equation, like I said, net absorption has slowed a lot. It's basically barely positive in the market as a whole right now. But we are seeing a lot of data points that suggest that we're at the bottom and that it's going to start to trend up. A few of them being containerized imports into the U.S. They were declining on a year-over-year basis almost all of 2023. But over the past 3 or 4 months, they've been rising on a seasonally adjusted basis, usually anywhere between 9 and 15% pretty consistently over the past 3 months. So that's more goods coming into U.S. ports, more throughput, in distribution centers across the country. We're also seeing leasing activity start to pick up. So leasing really peaked, again, at the end of 2022 and had been trending down for several quarters, but it's actually just been in the second quarter of 2023 that we're seeing early signs in the data that leasing is going to be up 20 to 30% in Q2 compared to the same period a year earlier. And we also know that Amazon is back on offense. So they've already signed more 1 million square foot leases so far this year than they did all of last year. So these are not things that you typically see when net absorption is about to get worse. These are saying that we're probably at a bottom and we'll see an uptick. I think the question is, how strong is that uptick going to be? And that's the hardest. That's the hardest thing to predict. And to be honest, right now, usually for me, it's easier to predict kind of where the economy and where tenant demand is going in the near term than it is, say over the next 6 to 12 months, than it is beyond that. But in some ways, I feel the opposite way right now. Just me personally, I think that the Fed is keeping interest rates higher than they need to for longer. I know you've got guests that feel the opposite, and that's fine, but that's just what I'm seeing. But just to kind of give you a sense, like, I'll rattle off some things here. And I know that folks it's very confusing to track, okay, what's weighted what in CPI and how is this even calculated and what's going on here, right? So just back away from the CPI, and I'm just talking about like prices of essentials. So gas prices, retail gas prices, they're down year over year. Chicken breast per pound price down year over year. Wholesale used car prices down. Walmart and Target have said that they're going to be discounting large numbers of goods to stabilize sales. And McDonald's brought back the $5 value menu, right? So I'm not actually seeing. I know that prices went up a lot during the past 3 or 4 years, but I'm really seeing that momentum slow. But what is still very high, credit card interest rates, those are at 30-year highs right now, 22%. Mortgage rates, they've come down a little bit from the recent peak, but prior to that, they're at the highest levels in 20 years, right? And so, number one, I'm worried that the taking a more academic approach, the Fed's leaving rates longer than they need to be, higher than they need to be for too long, which makes me a little bit concerned about the path of the economy and the consumer in the near term. But at the same time, that makes me more positive on the long term, because I don't know the speed or the exact timing at which this is going to play out, but I would not expect mortgage rates and credit card interest rates to remain at 20 and 30-year highs in perpetuity. They have more downside to come down right now than they do upside to go up. And if that happens, credit card interest rates, for example, if they start going down, that's going to be putting money back into consumer budgets, because that's money that's right now being taken out of their day-to-day spending to service that debt. And that will free up more money to spend on consumer goods. And if mortgage rates come down, that will also lead to more people moving, more people buying all those things I just said, like mattresses, washing machines, sofas, et cetera, that take up a lot of space in distribution centers. So we see some positive indicators from tenant demand in terms of the near term. I'm a little wary how fast that pickup will materialize, just because of what's going on in the economy. But when I think about most real estate investments are 5 to 10 years, and so when I think about what could potentially cause consumer spending to increase over the 5 to 10 year period, I see a lot of upside in terms of inflation and interest rates coming down, and what that would allow for spending, and then for so much of especially logistics leasing is driven by just the amount of physical goods that people are consuming, because that all needs to be stored in distribution centers.
Yeah, great points, and very well said. What's your take on it being an election year and looking at how perhaps the market reacted or evolved in past elections? Do you think that is is going to have a similar type of impact compared to past elections? Is this different? What are your thoughts on that in general?
I mean, it's just generally, it's just not good for the economy because there's a period leading up to the election where big businesses will pull back on making new investments because they say, okay, well, why not wait another 6 months to see, have a better sense of like what the new tax regime, is going to look like, or spending regime is going to look like before we make these big decisions. So just in general, like having an election coming up is typically causes some slowing. It's not usually a positive. I really would hope that the Fed would just not even be thinking about that at all, and just kind of doing their job and focusing on what they're seeing in price changes and employment, which is their mandate. And frankly, I don't see much reason for them, like pointing the finger at them to be biased. I don't. It doesn't make a lot of sense to me because, in sort of trying to help the current administration, because they just increased interest rates more in a shorter period of time than anything that had happened in 50 years. So, I think for them it's a lot less about the election and a lot more just they were late to respond in the first go around to this inflation cycle, and they probably don't want to be accused of that happening again. But when I look at the inflation data, the price data, the economic data, to me it looks like it's time to start lowering rates. Maybe not dramatically, but at least marginally. Especially because, there's a lag in terms of seeing the effects, and then on top of that, there's a lag that the data needs to come in to show what the interest rates have actually been doing. And I'm seeing that job market is still healthy, but it's slowed a lot. And as I said, prices of all these goods, essential goods, are not really going up. I know there's a lot of services inflation, but that's my. Everybody's got their own opinion on the Fed, right? That's mine.
Yeah, I appreciate that. So going back to data that you're following and then maybe going from a macro view to a micro view, are there any markets that you're following that are more interesting, either from a good or a negative standpoint?
Right. Sure. Yeah. I'll do the good just because, people like to hear their market's doing well. And I spoke a lot about kind of the rising vacancy in the bulk distribution market, but it's not as if we have, frighteningly high vacancy in that category in the whole country. That's definitely not the case. So I'll kind of talk about some places that look interesting on the bigger box distribution side. For me, I make all kinds of screens looking at data, just trying to show which markets are the tightest, which markets are most likely to tighten further over the next year or two. And one of the areas that just pops up near the top of every single one of those tools that I make is the I-81, I-78 corridor in Pennsylvania. So for example, one of the things I look at is sort of like a years of supply metric. So what I'll look at is the amount of vacant space existing today and the amount of unleased construction. Add that together. So that tells you like how much space is there in this market that needs to be absorbed. And then divide that by average annual absorption over the past 10 years. Within that market or within that property, within a specific property size range. And so that basically tells you if absorption just basically it holds at the 10-year average, how long would it take to fill all this space that we have on the market? And when I do that, especially in the bulk distribution categories, properties 250,000 square feet or more, I-81 in PA ranks as some of the best on that list. So it says that if we get 10-year average absorption, we'll work through all the vacant supply that we have in about 2 years. Whereas for a lot of the other big markets, it's more like 3 or even 4 years plus, especially in places that have seen a ton of spec construction. So it's shaking out well in terms of what our data is showing. And so just why is that? You can reach more people in a 4-hour truck drive from that I-81 corridor in Pennsylvania than basically anywhere in the country. About, depending on where you are, about 35 to 40 million people. The reason for that is because it's near that New York, Philadelphia, Washington, D.C. corridor, which is the biggest cluster of purchasing power in the country, right? And so that's a huge deal, population within a 4-hour drive time, especially when you're in a world where, number one, the consumer preference for delivery times just keeps getting lower and lower and lower. But also, it's very hard to hire long-haul truck drivers right now. The amount of, at least according to the Bureau of Labor Statistics, the amount of long-haul truck drivers is even today with where it was in 2006. So no net growth in almost 20 years. Whereas when you start looking at the local trucking sector or for example, like local freight trucking or delivery van drivers, you see a lot of growth in those fields. And part of the reason for that is just that people don't want to be away from their families, for a week at a time, et cetera, going on the long haul. So what that means is that if you're trying to increase the speed at which your goods are getting to the consumer, it's really that last mile where you can staff up more drivers and deliver. It's easier to deliver products more quickly, and so that's what makes that I-81, I-78 market really essential. And just to give you a sense, like, even last year when Amazon was pulling back on their new leasing nationwide, they set a record year for leasing along the I-81 corridor. So they weren't slowing down there, and that's for all of those reasons that I mentioned. So that's one market that really stands out in the data to me. I'll give another example. Inland Empire, especially when you get into the very biggest properties, 500,000 square foot plus, 1 million square foot plus. I mean, that market's been kind of the property smaller than that, and the Inland Empire in general has kind of been the poster child for this like readjustment in terms of cooling down after a really strong run. And there is a lot of vacancy and availability in those I'd call it like mid-bay size properties, but it's more difficult to find sites to build those 1 million square footers out there. And that's what the tenants want the most, because these are, they're there because they want to be close to the ports of LA and Long Beach, where they're moving a ton of cargo. And so that segment of the market, when I do those years of supply metrics, especially in the bigger box ones, the bigger box end of the Inland Empire, that's another one that's saying, okay, if absorption just gets back to the 10-year average, this is going to be one of the markets where vacancies will tighten fastest. And it already is a pretty tight market in that sense. I got a couple more. It looks like we still have time. I could talk about these. This is these are my favorite thing. And I like it too, because these aren't really places. I'm trying to give you, everybody. I was at NAIOP Icon East, last week, and people were very big on Laredo and Savannah, and those markets, have incredible demand prospects just due to the trade shifts and everything. But those are ones I think people are talking about a lot. So, and when you have all the most active buyers in the industry kind of pointing to those markets, that also tells you, okay, I'm sure that they're going to do very well here, but how hard is it to now get in, coming in after them? So I'm trying to focus on places maybe people aren't talking about as much. Another market that's really, everyone talks about, the onshoring and reshoring of manufacturing, and how that's no question, that's a huge driver in terms of leasing. But the challenge that I'm seeing is that a lot of the markets where you're seeing the most of the largest number of those expansions. Well, first of all, some of the biggest plants are being set up in really small towns, where they have enough land to build out these facilities. So it's tougher for a big investor to come in and benefit from that. They'd have to go to a very, very smaller cities that they're not used to going into. But also some of the other markets that have seen the most demand momentum, they're also seeing the most spec construction. So even though onshoring is driving a lot of momentum there's a lot of availability. But one place that looks really interesting from an onshoring, but from multiple angles to me, is Tennessee, especially Nashville. So Nashville has they have LG and GM building EV related plants all around the exurbs of that market. And they already have a lot of auto industry, a big auto industry there in general. It's a very good distribution market as well, just because it's at a good location point in terms of being kind of in the middle of population centers on the I-85 corridor in the south and the 95 corridor in the northeast, and the Chicago area in the Midwest. It's kind of at the midpoint. It's a good distribution location in general. The second largest military base in the country is just over the border. It's only about an hour away from downtown Nashville, and that's a huge driver just in terms of anchoring, advanced manufacturing talent and even logistics talent in that market. And of course it has really good population growth as well. So it's like checking all the boxes. And you had the CEO and president of Dermody on a few weeks ago, and he was talking about, it's not just important to go to places where there's demand momentum, but at least if you're doing a long-term investment, you want to be somewhere where there's at least some checks on the amount of new development that you could potentially compete with in the future, right? This is something that I feel like newer folks in the industry don't understand right away, because you might look around a market and see, oh my God, there's an incredible amount of construction here. This must be a very strong and healthy market. And in a lot of ways, that's true from a demand and a leasing perspective. But the more construction you get, it can suppress longer term rent growth because you have more supply coming. So I'm glad that he brought that up, because I'm doing a similar thing when I look at markets. You look at markets where there are really strong demand drivers of demand, but also where you cannot just build in perpetuity. And so the I-81 was a good example I forgot to mention, but that part of Pennsylvania, it's a critical distribution point, but it's pretty mountainous. So you can't just keep building further out forever, especially for the bigger boxes. You just run out of sites that are flat. And it's kind of the same thing in Nashville too. That's in central Tennessee. It's not as mountainous as the eastern part of the state, but it's relatively hilly, especially in many of the exurbs, which makes it challenging to find big flat sites. So that's one of the places where I think you see a lot of the good demand drivers that the Sun Belt has. But there are also some checks on the amount of future development that can take place. And Tennessee also, it always ranks in the top, 3 for availability and price of power, which is something I know all of your, pretty much every single guest that you've had, it talks about how important a factor that is, for growth going forward. So those are really my just 3 markets I think people don't talk about much, but I can see a lot of good trends happening there.
Yeah, it's, as you're saying that, it reminded me of a quote someone told me several months back. Very simple: flat land, flat rents. And I think that speaks to, that sums it up probably almost too neatly, because you need to explain it a bit more. But I agree with everything you're saying. If you can keep growing in every direction, if there's no geographical impediments, and you can grow every direction, you're right. What's stopping from just adding another 1 million square foot warehouse if you can just build it across the street? Whereas if you do have some restrictions, like Vancouver in Canada is a great example. There's just nowhere to go. They are just out of land. So now anyone that wants to be in that market either has to start looking to go vertical, which comes with a whole host of problems, or they're starting to go more inland, and that's not ideal because now you're further away from port and intermodal. So that's a market where rates have skyrocketed, where the market that I'm in, similar to Phoenix, similar to Dallas, you can theoretically grow in almost every direction. The rents in my market anyways have been pretty flat. And I think that probably will cause some upward ceiling on rent growth in Dallas and Phoenix as well. It's just from the fact that you can grow every which way, where I really like that point that you made on there, because I do see a lot of opportunity for investors to hedge against eroding profit by people just coming in and growing anywhere they want.
Exactly.
It'll be really interesting to see. Yeah, it's I completely agree with everything you said. So it's encouraging that when I have a thought on something, that it's actually supported by data as you're presenting. Because everything that you mentioned, I'm seeing myself and have heard many other people talk about as well. So I think that was a really good breakdown of both macro and some micro opportunities for people. What's on the agenda for you for the rest of 2024? Are there any trends that you're going to be following? Anything specifically that you're looking for? Election, we already talked about. That'll have an impact for sure. But anything that catches your attention just in terms of it being noteworthy?
I mean, the big question that's on my mind, we're already seeing signs that tenant demand, even on the bulk distribution end, is rebounding. And the big question that's on my mind is just how strong is that rebound going to be? So what I'm really looking at is absorption. I literally look at like our quarter to date absorption every day because I'm curious to see the momentum. But what I'll be on the lookout for is availability. So not necessarily vacancy, but just the amount of square footage that's being listed as available for lease. Looking for that to peak, and looking for specific markets where it's peaking, because usually that's a leading indicator of vacancy. So that's the main thing that I'll be looking out for, and hopefully writing a lot of stories about calling attention to the fact that, like, look, we know the market's not as strong as it was 2 years ago, but the signs of recovery are very clear, and here's how we can see them already playing out. That's what I hope to be focused on, in the second half of the year for sure.
Well, I've been a Costar subscriber for many years now, and the data is obviously very important to me, and having access to everything under the hood. But what I've really come to enjoy over the last couple of years is the articles, and even just talking with you, the number of times that I have just been very insightful for me, and it certainly helps shape my opinion and how I try to tell the story about industrial. So I really do thank you for the great work that you're doing, and taking the time to jump on the call with me here as well.
Absolutely. Yeah. Well, likewise, I really benefited from all the content that you've produced, and your guests. So I'm glad to be on here, and hopefully we can catch up again in a few quarters.
Oh, absolutely. I'd love to make this a recurring theme, actually, if you're up for it, because I think there's a lot of people that love hearing about this, but it either gets lost in the mix, or maybe it's too hard to digest if you're just inundated with a whole bunch of market reports. But I know for myself personally, if I can just tune into something and get a high level view of what's happening from an expert like you, I love it myself. So I'm sure others do as well. So if you're up for it, we could try to do this more regularly.
Sounds good to me.
Cool. I know you're on LinkedIn. Anywhere else that people can get in touch with you if they wanted to ask you a question or talk to you about something?
That's where I'm most active on social media. So that's the best place to find me, and or at aponsen@costar.com. Always good to get emails from folks in the industry.
Awesome. I'll put both those in the show notes as well, and look forward to keeping this conversation going.
Absolutely. Thanks, Chad.
Okay. Thanks, Adrian.